So let me just jump in with the laws behind this. That's something that I think people don't understand. So I know this comes from the Securities Act of 1933 and Reg D, which I suppose is an article of the Securities Act of 1933, or maybe a later law. But just help us get grounded in what the law is regarding a real estate company, really any company, but specifically a real estate company's ability to form an entity and sell shares and raise capital using Reg D. What's behind it all?
Sure. So as some background on Regulation D, the exemption was put in place in 1982. And the purpose of the exemption was to provide small and medium-sized private companies with the capability to sell securities to investors and not go through the same registration process that they would put, say, a public company through.
Right.
As far as volume, it's usually around $1.5 trillion that gets executed under the Reg D program every year. So it's probably the most widely used exemption as far as the umbrella exemption that exists within the SEC. Currently, there are a couple Reg D programs that are available. They did make some changes, obviously, in recent years. You have 504, and that is a program that now limits at $5 million. It actually used to limit at $1 million. I think you'll
so
still see that out
ceiling
there. Yeah, so the size of the amount of capital that you can raise in a 12-month period of time, that's what that's referring to. And if listeners to your podcast are out and they're looking on the web or something, they're probably still going to see references to the $1 million limit. That is an old limit. So the new limit now is a $5 million limit. 504 is a traditional private placement, meaning you can't do any open solicitation of investors. And really the litmus test there to keep you 100% safe is that ideally you ought to have a pre-existing relationship with whoever you sell to.
Okay.
The 505 program is actually non-existent. They did shut that program down. And in part because it just wasn't really getting utilized that much, we didn't really do any 505 work. And in part because 506B was one of the other Reg D programs, and that is really the program, if people weren't going to do a 504, most people were doing the 506B program, B Bravo. The 506 program, the B program, does not have a limit on the amount of capital that can be raised in a 12-month period. The other advantage with that program, and this is part of the reason why people then stopped doing 505s, is that it's a federally covered security. So as far as your state interaction, you're just providing notification at the state level. And so that was something that they brought in under 506B in 1997 under the National Securities Markets Improvement Act. So these days you've got 504, 506B, and then you have the new program, which is 506C. And that's actually the program that most people now are executing under, at least through our firm. And I think a lot of it comes down to when someone picks a company or gets professional advice on doing a Reg D, I think some of it comes down to, are they supportive of 506C or not? We're highly supportive of it. We actually lobbied the SEC in 2002 for something very similar. And the big draw with 506C is you could do general advertising and general solicitation of that offering out to the public. And that's it can't be understated, the advantage there, because it allows you then to bring in social media promotion, press releases, web search advertising. I mean, you could be as creative as you want to be to promote that offering. The other differences that are primary, a 506C offering is going to only be accredited investors that can participate. A 506B does allow up to 35 non-accrediteds.
Right.
The other thing I'll mention too is that 506B program is also a traditional private placement. You can't do any general solicitation or general advertising under that program.
I see.
So, and as far as the accredited investor definition, just so people might be wondering, well, what is an accredited investor? Yeah, income and net worth are your two primary ways. So income would be $200,000 a year, and they would have had to have hit that mark in over the last 2 years. 300 if it's a joint with their spouse. So if they're investing joint with their spouse, it'd be a $300,000 threshold, or $1 million net worth, and that would be excluding any positive equity value in their primary residence only.
Right. Right.
And
so,
then
those are things that even though there have been these exceptions that have been brought along with Reg D, those are, I suppose, the main meat of what happened in 33 with this Securities Act to make sure that you're not selling securities on a billboard to somebody's grandmother and she's putting her last dimes into it and whoops, it's gone because somebody bought stock on margin or something. I mean, that's the background on the act itself, right?
Yeah, well, and if you look at the timing of the act, I mean, what came right before that? The Great Depression, and the market turmoil. And so, yeah, I mean, the Securities Act really provided the basis for regulating security sales. And then Regulation D came on board in 82 as a way to allow a more streamlined way for a company to sell securities. And securities, you're talking, if it's a corporation, you're talking common or preferred stock. If it's an LLC, which is very frequently used for real estate, you're looking at membership interests or membership units.
Right.
Limited partnership units, if it's a limited partnership. But you can also have debt securities. I mean, that's the other thing that sometimes people forget is, well, we don't need to do a securities offering because we're raising debt and we're selling notes. Well, notes are securities. So even notes and
still
bonds
regulated,
being sold.
yeah.
Absolutely, yeah, absolutely.
Thank goodness. So in my reading on all this, and obviously also in my work experience, once you decide that you're going to make an offering and raise capital using the provisions of Reg D, then you go to basically the business end of it. You get around to this document, a private placement memo. So I have a ton of questions about that, but I've looked through some examples you had on your site, and obviously I know the ones that we use in-house. If you were going to try to sketch for people the basics of what's in a private placement memo, this primary legal instrument that's used to facilitate this transaction and raising the capital, how would you kind of give us the lay of the land of what goes into something like this? I know that's a big question.
Sure. Certainly the private placement memorandum is very important. And, we do things a little bit differently at our company. We do create our PPM documents to also be a presentation piece.
Right.
So if someone were to go to our website and look at our sample, it's going to look different than what a traditional PPM is going to. Yeah. We do that for a couple reasons. Number one, what we found over the years leading up to starting doing those types of PPMs was that people were including their business plans as an exhibit to the PPM because they wanted to bring that sales piece in because the PPM itself was kind of dry reading. And
well, it can be 80 or 90 pages of Times New Roman, half of it in all caps, right? I mean, it can be pretty daunting.
Absolutely. Yeah, and I think what happened was then is people naturally wanted to have a sales aspect in there, and the problem is number one, it just wasn't an elegant solution, just dropping a business plan in as an exhibit, and number two is that you started to run into some issues with congruency between the documents because you need to have the private placement memorandum and the information disclosed in there. You've got to have that be congruent with what's in the business plan.
And you're always having to synchronize these two evolving documents. I've run into that all the time.
Yeah. So that was the reason why we started our model, which was, okay, let's just from the outset create a presentation piece. I do think as far as the balance between the two, absolutely what takes priority is having a technically accurate disclosure document. And because the purpose of that document is to disclose, it's to protect the issuer, it's to protect investors, it's to make sure that all parties get all the information they need to make an accurate investment decision. I think from there, then you can then build in the elements of making it a high-end presentation. But absolutely, when we approach drafting a document, the first thing is we need to create something that's going to be technically accurate, compliant. We draft to Form 1A, which is the same level of disclosure they use in Reg A's and registered type offerings. And so I think that's where the primary focus needs to be because of the purpose of the document, but that doesn't mean that you can't also bring in some presentation aspects and make it a document that also does a good job of engaging investors.
Right. Who are, after all, I mean, I've seen some of these presentations and you'd think, all right, this guy's about to cut a $500,000 check or $250,000. they still want to see pictures. It remains, even though obviously this has to be all dialed in. Like real estate, it seems to me an inescapably emotional thing that people want to make sure the IRR is there and they want to make sure the cash and cash. But what's it look like? Am I going to want to drive people by this and say I've invested? So I think that's a wise move. I remember in one of the pages of your document, which again I think is one of the nicer looking PPMs I've ever seen. It is interesting though. You have that contrast. Like on one page, I think it was right as you go into your disclosures, there's like a couple, and you're like, okay, this couple might be investing in these securities, and then the next page is like, please note the warnings that you need to. It's just an interesting juxtaposition. But to your point, I think that's the best way to do it. I think you're doing it extremely well. So given that background, that this is equal parts advertisement, but first and foremost a legally precise description of the risks involved and so on. How would you kind of break up then the content from there? Now that we know kind of what it is, the different say the main eight or nine different ingredients that are always going to go into a PPM. And I can I'll flash some slides up as we go, but.
Yeah, absolutely. Well, so you're gonna certainly be discussing the company's operations, and really that's where a lot of it comes down to what kind of company are we dealing with. If it is say a real estate fund, what we're going to be focusing on is what type of asset class are they focusing on? What are their markets that they're focusing on? What are their sourcing techniques? What are their vetting techniques for these assets? What's the management strategy? So one of the key parts of a private placement memorandum is that operations section, because it's going to really disclose in great detail the entire operational plan for the company. Certainly, if it's a software company or something like that, the disclosure is going to be a little bit different. But that's where just a lot of the custom creation comes into play. Every deal's different. Every company's different.
Yep.
And I think as well too, you also want to focus on things that are important. Are there competitive advantages that this company has, for example, or are there some unique risks that they may face? Do they have one distributor for their product, and if that distributor goes out of business, that they've got a real problem? So
Right.
Those are the things as far as analysis that really help. You're also going to have obviously the investment risk section, and again, that's where a lot of customization comes into play. Every deal's different. There's certain risks that might be very particular to a certain industry or a certain company. You're also going to have sections that are describing the securities that are being sold and the investment terms. And again, you're going to have variances there. If it's a real estate deal, we typically are seeing LLCs being used, and then we usually will have a two-class structure. We'll usually have a Class A membership interest for the investors and a Class B interest for the beneficial owners or the manager. And in that way, then it allows us to very cleanly articulate the distributions of net cash flow, liquidation rights, voting rights. There's a lot of differences then that we can efficiently articulate between those two classes of members within the LLC. You also run into then sections that talk about current ownership, whether there's any litigation on the company, and how to subscribe for the securities. Usually, most offerings also have a minimum offering amount, so there'll be some disclosure in there about the holding account and the terms on that holding account as far as whether or not the offering executes past that minimum offering amount, and obviously protecting investors up to that point by having those funds go into either a segregated account or a third-party trust account.
Right.
And then from there you'll have exhibits. The exhibits are there really to bolster the information in the PPM. You might have supporting information. You might have market reports, appraisals. You'll certainly also have operating agreements if it's an LLC.
Yep.
And then, then you'll have your subscription documents and your investor questionnaire, which is obviously the agreements that they'll be executing to execute the investment.
So as I was looking at this, that's exactly what I was looking for. I was listening at this. It's interesting because you were talking about risks. I think other than the supporting information, which is actually a collection of several different things, on your table of contents, your certain risk factors, I think, was 10 to 12 pages. It was the longest single component, in this 120
Yeah.
some odd, that's what it has to be, and there's just so many different kinds of risk. And then what I also thought was very interesting, and as somebody who spends all my day doing financial analysis, or a lot of it at least, I was struck, and this was just an example that you had, but I was struck by, and really I suppose it's true of our PPMs as well, that the financials, section is usually like 4 pages. I think it was 3 in this one. A lot of times in ours it's 4 or 5, and by 4 or 5 I mean like, the real guts, financials. Obviously, there's allusions to the debt and equity structure elsewhere, and there's allusions to interest rates and refinancing timelines and so on. But in terms of like, here's an income statement, here's a waterfall, here's a development budget, it does seem to be pretty succinct. I mean, I guess is that just because they are after all projections, so it's not as if we can add a lot of clarity by adding 20 more pages. But is that what's your read on that?
Yeah, so again, a lot of it depends on the company. I mean, we might be dealing with a company that's been in operation for a while, so we'll have historical financials in there, current balance sheet, and then typically financial projections. There are companies where you just can't accurately develop projections. I mean, an M&A fund where they can't even tell you what type of company that they're going to be purchasing, its size, its revenues. I mean, they may have obviously, target type companies, but so there are certain deals where developing projections would be almost impossible, especially impossible to get into any kind of realm of accuracy. But something like a real estate deal, or a deal where that you can have accurate assumptions, a company that's selling a widget, where you can have assumptions on, hey, if we sell X number of widgets, we're going to have this amount of revenue and this amount of expenses, then yeah, you'll normally have projections. I'm a fan of keeping things fairly succinct and straightforward, mainly because I understand that the audience for these documents, it might be the orthodontist down the street that's interested in putting $100,000 into your deal, and he's probably not going to want to see, your projections for, April 6 years out. And we'll get that. We'll get clients that have developed month by month projections for 4 or 5 years, and it's just, it's a lot of data that people probably aren't going to read. So I'm more of a fan of keeping things fairly succinct. At the very least, if you have developed that much data as far as projections, at least have some summary sheets that allow people to see by year the performance of the company. Because in general, that's going to be what they're looking for, is summarized info, in my opinion.
So let's talk a little bit about the process. And there's a phenomenon, kind of a chicken and an egg paradox, that I have seen play out often with PPMs, private placement memos. You kind of alluded to it a little bit with the merger and acquisition situation, where somebody's trying to get capitalized, and then they're going to kind of be pre-approved to go out and maybe do some acquisitions. It's sometimes a tension between, I want to have this thing done so I can hit the street and raise capital, so I want to kind of produce some drafts, but on the other hand, that maybe the deal is still formulating in my mind, and we're still working out. I'm waiting to get my financing commitment, or I'm doing this and doing that. There are a couple of variables which are they may slightly change, the percentage between Class A and B, or what exactly the preferred return is, or the note structure. And so, what's the workflow when somebody comes into your office and says, Doug, hey, we want to do this real estate deal, and it's basically going to be, this kind of project. When should we come into your offices and or get on the horn with you and get this thing, in the chamber? How early before a closing would you say you attempt to start working on this? And what's your kind of workflow and timeline once that process begins?
Sure. Well, I'll let me maybe go a little bit more specific and say that if it's a single asset acquisition, a lot of times there's a short time frame to get the offering prepared because the sponsor may have put that property under contract and now they've only got, 90 days to perform on that contract. So we've obviously then got to get the offering documents prepared as quickly as we can. We can pre-build a PPM in that case, and really what we're doing there is we're building out the PPM with as much information as we can, minus the specific property data. And we can actually get pretty far down the road with the PPM. I mean, we'll have information on the special purpose entity, the management team, the market they're operating in, the type and asset class that they're going to be purchasing, management fees, investment terms. I mean, there's a lot of things that we can get done. That way, when they do then come to us and say, okay, we've got the property under contract, we've got maybe a week lead time to finish off the PPM document. Mm-hmm. If it's a blind pool real estate fund, they're not normally under the same time frame issues because, yes, they want to go out and start acquiring assets, but they don't have anything under contract at that point. So there isn't that finite deadline where we've got to get them out on market and they need to perform or they lose the contract. So if it's a single asset acquisition, you want to get in as early as you can, obviously. And, really too, before you start interacting heavily with investors, because there's going to be questions investors ask and there's going to be information investors want to know that really is only going to be able to be articulated through the private placement memorandum and going through the structuring process. Yep. One of the things that you'll find with a private offering is you're usually not going to have that much in the way of negotiating, meaning if you're raising $5 million, you're probably going to have 20, 30, 40, 50 investors, and they're going to take what the terms are. Here's the terms. Here's the terms on the membership interests. You're either going to take it and purchase and subscribe or you're not. The only time we really see that change is if there is a big investor that comes in and says, okay, I like the deal, I like the asset, I like the management team, but I want a slight tweak to the investment terms, and I'm willing to fund the deal, the entire deal, or fund a significant portion. Then maybe you'll see terms get changed. But if you've got obviously security sales that have happened prior, you now have to offer those same people the same terms. So as far as the process goes, really initially what we're doing is working through getting a lot of our base information. We have a very detailed new client questionnaire that we initially start with. That gives us a lot of our core information to get the file started.
So it's a poll. You're asking. They're not saying, "Hey, Doug, put this in." You're saying, "Here's my questions. Fill this out, and I'll know what to put in."
Well, the questionnaire is really just there to give us some of the basics. Certainly. Company name, formation date, who are the managers, who are the owners. What's the plan forward operations? We start getting into investment terms and structure, management compensation. We also have some discovery questions in there. Is there any litigation against the company? Do any of the principals have any bad actor issues that we need to know about? But from there, really, then it's just custom working with the client. Is it a self-storage fund we're working with? Is it a multifamily complex you're purchasing? Every deal is going to drive different information essentially that we're going to need to get in. Once we've got enough information in, then we start obviously our drafting work on the offering documents. And then that's just a series of drafting, revising, working with the client, adding in exhibits. So it's definitely a process to get that stuff in place and get it finalized. Once it's finalized, the client's ready to go raise money. You actually don't have to have the filing in place to go out and start executing sales. With that said, once you execute your first sale, it does trigger a 15-day window within which you need to get the Form D filing into the SEC.
By 4D filing, you mean they have to get copies of the executed placement memos? Help me understand what you mean there.
Sure. So the Form D filing is the filing that goes into the SEC and notifies the SEC that you're doing a Reg D offering. And it's actually, I think, one of the benefits of Regulation D in that your interaction with the SEC is notification. Now, granted, they have rules related to how this offering gets set up and disclosure and how it executes, but you're not seeking an approval from the SEC. So as far as
heads
timing,
up, you're just letting them know.
Absolutely. And so as far as timing goes, really getting to market and starting to sell securities is really a matter of just getting the structuring done and getting the offering documents in place. Now, we do get the filing in place as the client executes, and there's a reason for that. We actually use it as a marketing confidence building piece. We have
Right.
an
I'm
investor.
sending this into the SEC.
Yeah, absolutely. Well, and we've got an investor web portal application that actually clients can use where it'll take the investors and the prospects through all of these processes. And in the prospect level access, they can access the private placement memorandum, but we also give them access to the filing because we found if they can access the filing and view it, it just builds confidence that, that, hey, this is an SEC filed offering.
Yep.
And it is a publicly available filing anyway. So they could go to Edgar, which is the filing repository and database, and pull it if they wanted to. We just make it easy for them to access it through our online application interface.
Is that Form D sent for each person who subscribes or for the offering as a whole?
It's for the offering as a whole. There is an area on there where you're going to denote how many investors you have and how much investments come in. And that's one of the primary things that you really kind of keep updated as the offering progresses.
Okay. I want to start turning to the process now. This is a brief question, but it's just something that I found very flabbergasting about the whole business, which I guess is changing now under 506C now that you can just kind of advertise out in the open. But I bought a few weeks ago a list of accredited investors in a certain market, 1,000 people for $90. Now, I don't know, how good this list is, and so on and so on, but I was just shocked that there is such a, you can buy these things. Like, is that something that you've come across? Like, did you find that as strange as I did, that there's this data out there that people just buy? I mean, isn't that pretty shocking?
Yeah, I think it comes down to obviously the quality of the list. There are a good list provider is going to constantly be obviously grooming that database.
Exactly.
They're going to be in contact with these people. Hey, what kind of deals are you looking for? Are you looking at energy deals? Are you looking for real estate deals? So a really good list provider is constantly going to be going through and culling through their asset base to make sure that they've got accurate contact info and to make sure these people are legitimately interested in private opportunities. And again, I think that's an advantage of 506C is it does allow you to do that. It allows you to go out and do mass communications and get, maximum exposure for the offering. Whereas under the old rules, say a 504 or 506B, you really couldn't do that.
I see. Yep.
And the thing is, too, there was a lot of gray areas and still are gray areas as far as the solicitation rules under the old programs. We were always very conservative over the years, and we had to be. We would have clients that would say, hey, what if I send this mass email out to my Outlook Express contact base? It's probably going to be a bad idea, even though technically they could maybe try and claim they've got a relationship with these people. It's still going to be a bad idea as far as putting you into a gray area where a regulator comes in and looks at it and says, no, you violated the rules, by doing this. So
that's one of those things, you don't want to happen for an SEC regulator to say, that's not kosher. So let's talking about actually selling the shares. And honestly, I've done considerable research on this, and I mentioned this when we were setting this up, trying to find a plain language explanation of when if I get you guys to create a PPM for something, who can sell these shares? Anybody can meet with somebody for coffee and say, here's the document, let me explain the terms of the deal, the risks, and so on. But that regulatory piece gets passed on down to this part of it now as well. The using this document in order to actually facilitate the transaction. FINRA, as I understand, is the agency that I don't even know what that stands for, but they have all these different licenses, and that brings you into the realm of getting licensed to be a stockbroker because you're selling securities. But I've also heard that if it's a PPM that's for your own deal, quote unquote, or for a company you work for, you don't have to have that license in order to sell those. Could you clear up the fog that reading about all that has created in my mind?
Absolutely. So if you're an authorized manager of the company that's executing the offering, you're going to be empowered to execute the security sales on behalf of the company, and you're not going to be required to have a license. In general, I mean, so if it's a real estate operator and he's formed an LLC and he's the manager, or a company he controls is the manager of that LLC, they're empowered to execute subscription agreements. They're empowered to put that PPM in front of people. They're empowered to execute that offering on behalf of that issuer entity, because they are duly authorized managers, within that company. Where you want to be careful is having third parties involved. Now, the other group that can sell the securities is obviously a licensed securities broker. So they could certainly take that PPM, put it in front of a client, have them execute the subscription agreement, cut a check. I mean, they can take that person through the entire process, but they're licensed. Where you've got to be careful is people that are unlicensed. So if you've got a finance broker or a finance finder and they want to take the deal out and put it in front of investors, that's where you've got to be really careful from a number of standpoints. Number one, you need to be careful of the statements that person's going to make. Are they sitting in front of these investors and saying, hey, you're going to be guaranteed a 14%, annualized return, when in fact there is no such guarantee of such return?
Correct.
Number two is they're not empowered to execute agreements on behalf of the issuer. And really, in reality, I mean, if it's my client, I don't want them handing them the PPM. I don't really want them doing anything other than refer the person over to the company and let the company directly handle everything from there. The other thing that you have to be careful of is the payment of fees, because certainly a licensed securities broker can take a commission. So, if it's a licensed securities broker and he sells securities to his client, he absolutely is empowered to take a commission on that sale. A finance broker who's unlicensed cannot take a commission. And yet, most of the finance brokers that are out there are probably going to want a percentage. They're going to want 3 or 4% of whatever their client invests. And that's where, A, you've got to be careful, but B, that ought to be a signal to you that this person hasn't dealt with securities offerings before if they're not aware of the fact that they actually can't take a percentage-based type commission on that sale.
Okay, so they can't take a percentage because they're not licensed.
Correct. Now, there is a carve-out to allow payment of a finance finder's fee, but again, I feel like finance finder's rules kind of put you into a gray area. The ideal finance finder's fee is a flat fee that isn't even success or performance based, meaning you refer an investor over to me and I send you a $200 thank you check regardless of whether that guy decides to invest. And that $200 is not a function of any kind of percentage of what the person invests. Anything beyond that puts you into a gray area, meaning even so much as me cutting that thank you check to you, but I wait and make it, performance based where I'm waiting to see if the investor invests. So that's the other thing that people should be aware of is once you've got a securities offering in place, you've got to be very careful about third parties getting involved in interacting with investors on your behalf, and obviously the payment of any fees.
Do you know, so in order to kind of ascertain whether someone who's suggesting that they sell your securities is outside of that gray area and kind of in the black, so to speak, do you know by chance what those licenses are, that kind of the most standard licenses that people would be carrying, just to ask, what is your license?
Well, typically Series 7. If they're licensed, they would have the knowledge, or their broker would have the knowledge of what licenses would pertain to those sales. Typically, a Series 7 is going to clear them to be able to do sales. If they're not licensed at all, then again, that's going to be a red flag. And it doesn't mean that they can't refer an investor to the company, but they just need to understand that they really shouldn't be handling the PPM, they shouldn't be making investment representations, and they definitely shouldn't be taking any kind of fees that are commission-based.
Do you have to be, this was a question I saw online, do you have to be working for a broker-dealer in order to take the licensing exam for Series 7, or can any individual just go and take the exam?
Well, your license, you're stepping a little bit outside my bailiwick on that one, but your license does need to be held with a broker. So for the most part, if you're an individual rep, your license is, if it's active, is going to be held with a broker.
Okay, I see. And becoming a broker oneself must be a gargantuan task, I would imagine, just because of the volume and the level of regulation. I have to imagine that step up. I know in even in commercial and residential real estate, you have salespeople and broker, but I have to imagine the step from Series 7 to I am a securities broker dealer is a order of magnitude different.
Yeah, it's definitely different. Obviously, you could certainly go to a broker dealer, study, take the tests, pass the tests, get your Series 7, get your Series 6. There's a big difference between that and being a rep, a licensed rep, and obviously being an actual broker-dealer firm. Once
Right.
you're a broker-dealer firm, there's all kinds of rules and regulations. I mean, those firms have entire departments just dedicated to compliance.
Are there household names that are broker dealers in this respect? And that may be something. Maybe a bunch of companies do this kind of thing, and I'm not aware of it. But just a securities. I guess. So I guess. What's an example of a broker dealer that can sell these kinds of things?
Well, I mean, most broker dealers can. What you'll find is that most of the broker dealers that sell private placements tend to be your tier 2 and tier 3 size firms, meaning your regional size and smaller. And that doesn't mean that your Goldman Sachs of the world don't sell private placements, but usually if they're going to sell a private placement, it's probably for a huge institutional client to another institutional client, and they execute it under 506 just to keep things compliant. But in reality, it's a completely different size and scope of transaction than a real estate operator that's got a $5 million offering. Part of the reason why some of the smaller broker dealers sell private placements is obviously A, the commission income, but B, it also gives them a separate and unique investment product that they can offer to their clients. And so, I can put you into Google and Apple and mutual funds just like the big guys can. I can also give you access to private oil and gas deals because we sell private placements.
Right. Okay. So then a few more specific questions here. I wouldn't call this a lightning round, but these will be a little slightly leaner questions than some of these huge ones have been. So, would you say it's possible to generalize of the real estate PPMs you've done, what percentage of people choose to offer shares as equity versus debt?
I would say probably 85% of what we do is equity based and 15% is debt. A couple reasons for that. Number one, a lot of the real estate operators we work with want equity because it's a cash based type investment. It's cash on your balance sheet. You don't have default risk, and
I see.
It just it just provides them more flexibility. The investors are basically on board until there's an exit, and so they don't have the leverage risks. We do also do deals where they're raising equity and they're combining that with institutional financing. So maybe they're buying a $5 million multifamily complex. They're bringing $2 million in equity, and they've got a $3 million loan from J.P. Morgan Chase. So that's also obviously part of the reason why we'll see a lot of equity deals is the debt piece is there, assuming they can obviously raise the equity. The debt deals that we tend to do, I would say the debt deals we tend to do are more bridge type scenarios, because your private debt's going to certainly be more expensive than institutional debt. And in that regard, then, if we do execute a private debt deal offering for a real estate operator, usually it's there for, say, that operator to just do real estate secured notes or bonds. They just want to get the property under control, season it under their control for maybe a year or two, and then from there they'll recap it with some institutional debt, and that's what they'll use to take out the private notes. So 85-15 probably is the split, but certainly most of what we do is an equity-based type capitalization for the real estate operators.
How often do you see it, and you may have already answered this, when you have somebody who goes and get a traditional lender, they get a debt piece, and then they do their equity piece as debt?
It's possible, but some of those lenders are going to want to see cash equity coming in as the equity component.
Right.
The other problem is that the private debt you raise then is going to be in second position, and it's just a lot of debt that on the balance sheet.
Right.
Part of this also comes down to what's going to sell on market. There's certain investment structures that people are going to typically look for certain types of deals, and with debt, it's kind of hard to obviously build in a profit participation. A profit participation is much easier accomplished where they're getting a membership interest and they're sharing in net cash flow or sharing in proceeds from a liquidation event.
Yep. Perfect segue to the next question. Would you say in your experience that through the cycles and all that people tend to over or under offer, so to speak, right? You don't want to, if you offer a really sweet deal to the investor, it'll be easy to sell these, but then your operation's going to be tough because you have so many obligations. On the other hand, if you really kind of get this just over the hump so that you could sell it, it's a lot easier operationally, but perhaps harder to get financed quickly. What have you seen any trend? Because you must see just thousands of these. Do people tend to over or under negotiate when they're selling to investors?
We definitely have some very frank conversations sometimes with clients that are not within the realm of reality as far as pricing their deals. Ultimately, it's their deal. They can obviously price and structure it where they want. But as far as our firm, our professional duty is to try and get them to price it so that it'll be attractive on market. And really from there, yes, I do have clients that want to make it a really attractive deal. They're willing to, if an 11% annualized projected return sells it, they'll take it to 13 or 14 because they have not only the room to do it, but they just want to make it that much more attractive. And we certainly have clients that want to, that want to price it right on market, and obviously give up as little as they possibly can. I think that just really comes down to experience in the market. For certain types of deals, what are investors looking for? And there's a lot of things to take into account when you price and structure a deal. When is cash flow going to be occurring? When is the exit event? What is the exit event? Is it a recap or is it a sale of the asset? So there's a lot of things to take into account, but certainly we see both sides of the coin. I see guys that want to give up as little as possible, and we have guys that want to make it attractive and are willing to take less to have a successful deal.
Of the 85% of those deals that you do, which are equity, what percent of them use what I would call an industry norm equity waterfall? So Class A preferred, Class B preferred, then on the way up to a Class A getting 12%, we split it a certain rate, and then on the way up to Class A getting 15%, we split it another way. What percentage of those 85% that do equity use some form of waterfall like that, and what percent use some other arrangement?
Yeah, so you're usually going to have essentially two waterfalls. You're going to have a distribution waterfall for operating income, and then you'll have a distribution schedule for proceeds from a liquidation event. And a lot of it depends on the kind of asset we're dealing with. If it's an income-producing asset, if let's say it's a multifamily property, it's been operating for 3-4 years, it's income-producing, and they acquire it, there's going to be obviously instant revenue and income that we can start distributing. And in that case, then there'll usually be a preferred return distribution that's made to the investors. And then from there, once that's satisfied, any additional net operating cash flow is going to be split between the manager and the investors on a certain percentage. From a liquidation standpoint, typically your liquidation schedule is going to be obviously repayment of any senior debt that might have been on the property, and then B, repayment of the investor's capital, C, payment of any accrued preferred return if there was preferred return built into the deal, and then from there, then remaining proceeds would be split on a certain basis between the manager and the investors. Now, where things can change is obviously if it's not an income-producing asset. So if it's, let's say, a build-to-spec deal where I've got a real estate operator, and he's going to build a medical facility. And when they've got their certificate of occupancy, basically they're selling it. They've already got a pre-sale contract in place, and it's basically transfer of ownership over to the purchaser, and that's it. That's the deal. Well, in that case, then really all of your return is going to be loaded into that liquidation event on the sale of that finished constructed property. So now you've got some additional differences. You may still have a preferred return. It may still be some type of hurdle rate that gets paid first to the investors, and then once that's achieved, then a split between the manager and the investors. So a lot of it just comes down to the deal. Residential new construction, if it's a development project where I've got a developer that's going to put in 40 homes into a subdivision, those also have their own types of distribution schedules. So yes, most of them are going to have those distribution schedules. How they're set up, obviously a lot of it just depends on the deal.
Do you ever encounter or hear anecdotally from folks, who are your clients, that people get a check and say, gee, based on my private equity math, this check would have been slightly different. Do you hear of people investors auditing the checks that they get and saying, based on the year-end report that I got and I know how many investors there are, does that ever happen?
I'm sure it does. I think, one of the things that's important is make sure you've got a good CPA firm on board to handle the distributions and the accounting. I think where you can get into problems if you start trying to handle that yourself, and especially if you don't have a good basis on taxation law and taxation regulations and such. So I think that's just where, if you're going to go raise money from investors, if you're going to, run a fund or what have you, it's worth it to have a good CPA firm on board. They don't need to be a tier 1 firm, but they definitely need to have some experience in dealing with multi-member LLCs. And if it's real estate, then obviously dealing with real estate transactions.
Is there anything to be said, and I asked about this with some friends who do this, is there anything to be said for having an official, I've sometimes made $1 waterfalls, so for $1 of cash flow, the formulas are in here, and you'll see exactly how it goes to Class A and Class B. And someone told me you would never want something this specific included because it would become a stumbling block and people would get involved in like, wait, exactly how is this formula working? Would you agree with that diagnosis or that?
There's going to be there's going to be a very specific distribution schedule on net cash flow. I think where people start taking a close look at these distribution schedules is what constitutes, for example, net cash flow.
What's our in manager, that pool? Yeah, exactly.
Yeah, our manager fees being taken out prior.
Right.
So a lot of times when there's scrutiny of it, I don't think it's so much scrutiny of percentages or anything because those are typically fixed and outlined.
But of the classifications you're giving to these cash flows.
Yeah, exactly. If what is net cash flow? Is it X manager fees? Is it so I think that's a lot of times what they're looking at. Further, a lot of times too, there might be say working capital reserves that the manager pulls off. So if there's X amount of income after normal operating expenses have been paid, sometimes there's a allocation that they'll pull off to have a working capital reserve. And ultimately, if that working capital reserve doesn't get used, it still then gets distributed down to the investors as income, but it's held just in case they need some working capital. So again, it just comes down to fitting a solution to what the client's needs are, and that's where analyzing the client, analyzing the project, the cash flows, all of that stuff drives into how ultimately these investment terms get set up.
Penultimately, I chatted with two lawyer friends about this interview, both of whom have done, their fair share of PPMs, and by far their biggest question that they wanted me to relay was the question of how you think about your risk profile in, being the one who makes all these. And I guess that's for any lawyer in any transaction, but they were curious about whether, you do 4,500 deals, like, no, there's always going to be a deal that doesn't work. And of course you have risk you have risk. I mean, unless you're looking at different deals than I am, in which case we should really get together for lunch. But um, you're always going to have put a PPM out there for some deal that didn't work. Either it didn't work quite like people said, or it just fell on its face. How do you guys in-house think about legal exposure in that respect?
Sure. I think the biggest risk is the client not disclosing information to us that needs to be disclosed.
Right.
And
So
again,
you don't know it, and it didn't go in there as a result. Yep.
Absolutely. And part of the onus of that falls on us. We need to ask the right questions, but some of it comes down to, is there a nefarious intent there? Is
Yep.
there a pending lawsuit that they don't want to disclose in the PPM? And we've turned away clients, we've terminated client agreements with people and returned funds because we haven't gotten a good feeling from them. Because when we start asking questions, we start running into answers that lead us to believe that they're not being 100% truthful. So I think, where there's a lot of risk is on something like that the client doesn't disclose something to us that's pertinent and material. As far as development of the documents, 506C, there is no mandated disclosure standard. So by drafting to the Form 1A standard, you're really going to the opposite extreme. And I think that helps. It helps protect the client because they've used a disclosure standard that's well above and beyond what they would have been required to utilize. And I think, too, proper guidance, look, if things aren't going well, be upfront with investors. I think part of the problem sometimes managers have is they don't want to make the phone call and say, hey, we lost money last quarter, or we lost this distribution agreement, or things aren't going the way we thought. The sooner you can start getting some direct lines of communication with investors and let them know that things might not be going according to what your projections were, the better. Because I think the moment you start trying to hide things, that's when you start really running into some problems.